probably around 248, 249. If you can
So it's not mostly same students.
it's mostly different. Yeah.
Okay, so same thing.
Yeah. Okay, folks. So yesterday, on my day off from teaching, I went down to West Point to teach 3 finance classes. Okay? And everybody was dressed in camouflage, and they all said, yes, sir, no, sir. So I was thinking of instituting a similar policy. You all have to dress in camouflage to show up and salute. No, it's actually fun. It's kind of an interesting place to be. So today we're going to be done with pricing. So tomorrow you're going to get an email nagging you about, you know what, right? Have you priced your company yet? And pricing is a much more compact process. It's a more pragmatic process than valuation. You're not asking what's the right thing to do. It's what everybody doing. So let's do, because today we're going to complete pricing, let's do a few very simple tests about pricing. So I just pulled this page up. This is from an equity research analyst report. And what this guy did was he went crazy. He basically had a bunch of different multiples sprayed onto a page. Nothing significant in each of them, but every multiple you get a different conclusion about a stock. So let's carry this to the next step. Let's take your company. You could price it with PE ratios. You could price with EV to EBITDA, EV to sales, price to book, EV to invested capital. You could potentially use 8 different multiples, and you could get different values. And you will get different values. You will get different pricings for your company using different values. So assume you're trying to do a pricing of your stock, because one of the things I ask you is, what is the pricing for your stock? I have a simple question. You've tried 8 different multiples. You got 8 different pricings. Which one will you pick? So let me give you the choices. The first is, why pick one? Why not just take an average of the 8 pricings? Right? So you get the law, I guess the law of large numbers working in a strange way. The second is you can use the multiple that most analysts in this sector use. And you can probably find, if you go online and look for equity research reports around, you'll see a multiple show up over and over. The third is you can pick the multiple that best captures what investors are pricing assets on at that point in time. So this has nothing to do with what you think, I think, or what analysts think. It's what's the market pricing in. The fourth is you can pick the multiple that best reflects fundamentals in this sector. How are you going to find out? You run R-squareds, you pick the highest R-squareds, and that multiple works really well. Maybe the answer is none of the above, in which case you should tell me what you would use instead. What do you think the right answer is? Because you're going to face this. This is a pragmatic issue you're going to face in pricing your company. Average, first, what's the upside and downside of using the average? The upside is you get the law of large numbers working in your favor. The downside is you get some crappy numbers in there, right? If you're going to use an average, you probably want to make it some kind of weighted average. And the weights will depend on how precisely each multiple. I'm not suggesting you should do this, but if you're going to use a bunch of multiples, averaging them out is probably a dangerous thing. You might want to at least reflect which pricings are more precise. You could use the multiple that everybody else uses, saying if everybody else is doing it, it's probably the right multiple. But the problem is in some sectors, the multiple that is used reflects a past that is no longer true. I'm going to cut to the chase. Pricing is a pragmatic exercise. You're trying to explain how companies get priced. What do you think the right choice is? Pick whatever works. You're saying, but that makes no sense. That multiple is stupid. Why would I use enterprise value to write it? You went down this path when you chose pricing. You're saying, I'm trusting markets to be right on average. You can't selectively stop it. I trust them on this one. I don't trust them on this one. So I'm going to show you the pricing I did for Twitter in October of 2013 when they went for their IPO. And you're going to be shocked at how I priced them. But perhaps you shouldn't be shocked, because in a sense, I'm going to reflect what investors were looking at then. Let's carry through. Let's suppose you finish the pricing for your stock, and you come up with a pricing of $20 for your stock. And you've already done an intrinsic valuation. Remember the DCF, and you came up with a value of $10. And the market price is right down the middle. It's 15. What's your final task in your project? You have to give me a recommendation: buy, sell, or do nothing. So I'll give you the choices. If you pick the pricing, it looks like it's underpriced, and you should buy it, right? It's trading at 15, you think it should be trading at $20 based on a pricing. If you look at the DCF, it looks like it's overvalued. So if you use the DCF, you're going to say sell. If you use the pricing, you're going to say buy. And there's a third thing you could do, which some equity research analysts and bankers do, which drives me crazy, which is take the two numbers and average them out. Averaging a DCF and a pricing is like saying you're going to be Buddhist until midday and become Muslim in the second half of the day. You can't split the difference here. They're two different philosophies, almost two different religions. You can't say, I'll take the average of the two religions and see what happens. Probably one of the other religions is going to excommunicate you, probably both. I don't know whether there's Catholics, I don't know, do Buddhists even excommunicate you? They seem too serene to be doing stuff like that. But whatever it is, you'll be shunned. Don't mix together a pricing and a DCF. So you have to pick. So which one should you pick? Louisa, which one would you pick? It's both under and overvalued, but you can't say I'll buy and sell, right? Don't try that on me, because that's not going to fly. Which one are you going to pick? Depends on how much you're willing to hold it. That's one part of the equation, and finish it. So if you're willing to hold longer, you will go with the... So you're saying if your time horizon is longer, you go with the DCF. Your time horizon is shorter, you will go with the pricing. That's one part of it. Is that all? Having a long time horizon, is that going to be enough for you to trust the valuation? Second is you might look at the catalyst, right? Which is, and you know what the third is? What's a word that I used at the start of this class? Faith. How much faith do you have in your DCF? I don't know what it is. You send me a DCF, but I didn't ask for a faith factor with it, right? How much do you, and that's going to come into play. That's why I can't tell you what the right thing to do is, because it's got to come from your gut. You have a valuation, you have a pricing, you're going to make a recommendation. You have to base it on how much faith you have at that point in time. And if you say, look, I've done a DCF, I can see all the numbers, they make sense, but I have no faith. I'm going to trust the pricing more. Why would I say that's wrong? That's actually the consistent thing to do. So there's an end game here, and at the end of the game, you get to decide which hook to hang your hat on. And that's going to depend on you. You know, to be a successful investor, who you need to understand, it's not Warren Buffett, it's not Peter Lynch, it's you. Because that's basically it. It's understanding what makes you tick, what makes you anxious. That's going to play out in that recommendation. So let's get back to where we were in the notes and kind of finish up the pricing part of this game. So I talked about, I think this is where we left off, is on page 74. So I get fired again. Remember, I kept getting fired last class, so I get fired again, and I'm on my final job. I'm now the .com analyst. Did we do this yet? Oh, we did .com. Did we do .com? Okay. Did we do the, so we got to the first part, right, where we tried the proxies. So we get to the part, we try the proxies, you can get that. There's another way I can get around this problem, because for those of you working with young companies, you're going to run into a very simple issue. When you look at your company today, what are you going to find? Small revenues, big losses, whether it's Square, whether it's Yelp. And when you try to do pricing based on today's numbers, you're always going to run into a problem, which is there's not much there. So you know what the solution is? Project out the numbers till there's something there. And you really don't have to do any hard work, because in your DCF, remember, you've got projected revenues in year 5 or 10. Take those projected numbers, and because you've made your company a profitable company in year 10, you can now use things like PE ratios, EV to EBITDA, because those numbers are positive in there. It's called a forward multiple. Basically what you do is, rather than pricing the company based on what you see today, you price them on what you think they will have 10 years from now. And analysts do this all the time. They will use it, especially in money-losing companies. I'm going to take the 5th year's earnings or the 10th year's earnings and apply a multiple to it. Nothing wrong with it, but there's something you have to remember about the pricing you get from that multiple. Let's take an example. Let's assume you have a money-losing company. You project it to have EBITDA of $5 billion in 10 years. And you say, look, mature companies in this business trade at 8 times EBITDA. So 8 times 5. is 40 billion. That's your pricing. Or is it? That's your pricing 10 years from now. So if I asked you, is this stock undervalued today, what would you need to do? First, you need to discount it. And that's just the start of the process. You discount it, you're going to come up with the value. I'm going to argue that value is too high, or that pricing is too high. Why? What did you start with? A money-losing company with negative cash flows, right? Those negative cash flows are also going to reduce your value. So I'll give you an example of how much a forward pricing or a forward value will be reduced as we adjust for different things. So about 5 years ago, I valued Tesla. And I valued them at about $8.2 billion. So the value that I got for the equity. So way back in time, $8.2 billion. Of course, I was, in hindsight, clearly way too low. But let's take that $8.2 billion. If you looked at that valuation, the terminal value you'd have seen for Tesla, in my calculation, was $69 billion. And people were puzzled, saying, if you're getting a terminal value of $69 billion, how come the value today is only $8 billion? So I actually wrote a post on how I get from $69 billion to $8 billion. I said, first, let's adjust for pure time value of money. Pure time value is just take the risk-free rate and discount back the risk-free rate. I lose $16 billion just by discounting at the risk-free rate. And of course, since it's not risk-free, if I add the risk factor, I lose another $25 billion. So I've gone from 68 to 28 billion by just discounting. But I'm not quite done. To the extent that they have negative free cash flows. Remember I said incorporating your DCF is your dilution? I took the present value of those negative cash flows and I lost another 15 billion. That's why I said don't adjust the share count for dilution. I've already adjusted your value. I've knocked off 15 billion. And then from that I subtracted out the chance that they will not make it, because embedded in that forward number is the assumption that I get to year 10. That failure risk reduces my value to 12.2 billion. Then you adjust for debt and cash, and you adjust for options, you're down to 8 billion. So all I'm saying is if you use a forward multiple and you make none of these adjustments, I wouldn't be surprised if you find your stock to be cheap, because all you've computed is the present value of the terminal price. And all that other stuff that's going to be messy in the next 10 years is being ignored. So if you're doing forward multiples, as some of you will have to do with negative earnings companies, watch out for that inflated number, because you have lots of adjustments to make to it. Any questions? I knock off things like 15 billion all of the time. Remember those free cash flows that you get, that you project out? If you have negative free cash flows, what is that for? What do you have to do? You have to raise funding to cover that negative free. I took the present value of just the negative free cash flows. Because remember, I'm looking at the pricing per share now, right? If I don't adjust for the dilution, I will overvalue this. So if I ignore the 15 billion and took the present value and divided by the share count today, I'm going to get too high a value. So by knocking the 15 billion off, I'm bringing in the dilution effect in your company. And with young money-losing companies, when you use forward multiples and you don't adjust for that, you'll always overprice the company. Okay?
Did you include those cash flows when you calculated the 68 billion?
No, that's just the terminal value. That's just the terminal value. So I'm explaining why such a big terminal value becomes such a low value today. And because that's all you're doing in forward prices, you're computing just the terminal price, right? And I'm saying it's misleading. It's going to be too large a number because you have all these adjustments you need to make to get to value today. Right? So in October of 2013, I did an IPO valuation of Twitter, just like I've done for Uber and Lyft. And I don't even remember. I got a DCF value of $18 per share. You know what the stock went public at, right? It went public at, I think the offering price was 28. And I was actually, the Reuters had this, before it opened, they had this little panel. And I made the mistake of agreeing to sit in on the panel because I thought as soon as the market opened, they would tell me how wrong I was and then I could just go home. At 9:30, the market opens and Twitter stock doesn't trade. It didn't trade till 11:30. You know why? There was an imbalance in orders. That's what the story was, which basically meant that the offering price had been set so low that the trades couldn't even happen. There wasn't a clearing price. Eventually at 11:30, it started trading at $45 per share. And over the next few months, of course, it went up to like 72. But basically, the opening date, my value was 18, it was 45. But while I did the IPO valuation with the DCF model, I also tried to price Twitter. And it's really messy to price a company like Twitter, right? Its revenues are positive. Everything else about the company was negative. So I said, let me try to come up with the pricing. So the way I approached it is first I had to define what companies investors would compare it to. And I picked basically the social media companies. They were all publicly traded, so I pulled up their market cap. And because I didn't know how the market was pricing these companies, I said, let me collect every piece of information I can. Revenues, EBITDA, EBIT. And because those were financial information, let me collect other pieces as well. I collected the number of users. And I computed some multiples, enterprise value to revenue. You think, which one should I use? I have no idea. PE, EV to EBITDA. PE, of course, is not meaningful for a lot of the numbers, so probably no PE, but EV to EBITDA, EV to revenues, EV to user. How do you break the tie? What did I say we should do? We should look to see what the market is pricing companies on. So what can I do? What can I use to estimate what the market is using to price these companies on? Remember in statistics you do correlation matrices? I took the market cap and I said, let me see what drives the market cap. Of course, it's very highly correlated with enterprise value for a simple reason. At these companies, it's almost all enterprise value. So ignore that correlation, but look at numbers like revenues, EBITDA, net income, and number of users. Basically, I want the highest number I can find here because that best explains differences in market cap. So guess what? At the start of in October of 2013, looking at how social media companies were being priced, if you ask me what's the variable that best explains their pricing, the answer is it's the number of users. So here's what I did. I went back and looked at the enterprise value per user. The median value across the companies, the reason I want to go with an average is going to get pulled out by the outliers. The median value per user was about $100. You want to price Twitter? Let me give you some numbers. Twitter has 240 million users. That's the only number you need. So what's the market cap you see for Twitter? 240 million times 100 is $24 billion, which works out, and this might be pure coincidence, to around $45 per share. If you're the banker and you have to take Twitter public, your job is a pricing job. You know how I'd have priced it? I'd just take the number of users multiplied by 100. That wouldn't have looked particularly sophisticated. So I'd have built a reverse engineered DCF to arrive at the same value. But the reality is pricing is simple. You're trying to reflect what the market does. So in October of 2013, markets were pricing social media companies based on how many users you had. I'm going to actually use that to explain a transaction which when it happened, nobody could explain. Remember when Facebook bought WhatsApp for $19 billion? You know how many emails I got right after saying, how the heck do you explain this with your stupid DCF models? And the word stupid was used intentionally. And think of why. How many of you have WhatsApp? Okay. How many of you pay for your WhatsApp? Okay. I think that in the undergraduate class, there was one guy who put up his hand. The biggest sucker probably on the face of the earth. Why would you pay for WhatsApp? You can use it for nothing. And in 2012, when Facebook bought WhatsApp, I would try to say, so WhatsApp's revenues were tiny because everybody used it and nobody paid for it. So, of course, your revenues are negative, tiny, your earnings, your EBITDA are all negative. So the question was, why would Facebook pay $19 billion for a company with tiny revenues? Put on your pricing hat. What were they buying when they bought WhatsApp? They were buying users. And the thing about the WhatsApp users, at least when they bought them, is they were users that were not Facebook users. Primarily Asia and Latin America, regions of the world where Facebook, they got 450 million users. And even if 100 million were overlapped, let's take the 350 million users that are unique users. How much could Facebook have paid for 350 million users? 35 billion. They got a bargain at 19 billion. It still remains the most read blog post on my blog ever, is that Facebook, because I said, look, we're trying to use DCF rationale to understand something that's pricing driven. But to give Facebook credit, they played the market game really well, right, of going for users. But they also remembered a fundamental truth, which is eventually what do you have to do with these users to become a valuable company. You got to make money on them. They still haven't quite done that with WhatsApp, because WhatsApp is still kind of a standalone app. But you can see the pathway to profitability here. Every young business has what I call a bar mitzvah moment. You know, if you're Jewish, bar mitzvah, you're now grown up, right? Basically, though you're never grown up. You're a 15-year-old kid. How can you be grown up? But at least in theory, every company has that bar mitzvah moment, which is, are you a grown-up company? When you're a young company, you're treated like a kid. Number of users, I'll reward you. Number of users, even more. I'll push up your price even more. But then the bar mitzvah moment arrives, where what do investors ask? You have lots of users, but when do you plan to make money? And if your reaction is, you expect me to make money? You never told me this. You've just failed the bar mitzvah moment. Facebook was ready for its bar mitzvah moment from its founding. So you can almost see everything that Facebook does. And much as we like to dump on Facebook now, it's exactly why they were successful, right? Let's face it, what makes Facebook's advertising so effective? It's focused. Why is it focused? Because they know a lot about you. Why do they know a lot about you? Because you vomited your private information into their laps and say, oh my God, you took away my privacy. And then we complain that Facebook has invaded our privacy. Of course they were sloppy with the information, but this is their business model. You traded a social media page, which is free, in return for every piece of information on you. And they used it really well to build an incredibly profitable business. So it's a business built around users. And I'll wager it's only a matter of time before WhatsApp becomes part of the Facebook ecosystem. This Facebook Messenger stuff was never going to go anywhere. They know right now. And remember the WhatsApp owners threw a fit and left the firm? Come on. You sold your company for $19 billion. What do you think they paid for? Free WhatsApp for the rest of eternity? I mean, I thought that was hypocritical to the nth degree. You sell your business for $19 billion. You sit around saying, oh, don't make money off that. Doesn't make any sense. This was a business where users counted, especially in 2013. Facebook did the right thing in buying WhatsApp, but they did the even better thing of saying, we're going to build WhatsApp up into an engine that can deliver future advertising revenues, future value. So if you're a WhatsApp user, it's only a matter of time before that Facebook component comes in and you become part of that advertising juggernaut that is Facebook. So looking across pricing, we've essentially looked at pricing across beverage companies, telecom companies. So basically in each one, though, I stayed sector focused. But if pricing is about looking at how investors are pricing other companies, why do I need to be sector focused? Why can't I compare my company to how the market is pricing every company in the market? You see the advantage you get when you expand your sample to every company in the market? Your sample size just got huge. But the pushback I'm going to probably get is, but you're now comparing your company to companies with very different growth rates, cash flows, and risk character. You're absolutely right. But what can I bring in as my tool that we've already used that I can use to control for those differences? We talked about regressions. We can control for the differences. If I can build a powerful enough regression, I could probably look at PE ratios across the entire market. So this year, at the start of the year, like every year for the last 30, I run that regression. And I've run it for the US market 30 years, with the global market only the last 50. You're saying, what regression? I try to explain PE ratios across the entire US market. And when you think about PE ratios intuitively, what's the one variable that you think should cause PE ratios to be different across? What's a companion variable for PE? It's usually growth rates. High growth companies tend to have high PEs. So the first thing I said, is that true? We keep talking about high growth companies having higher PE. So I took every stock in the US and I put a scatter. I mean, this is an incredibly messy looking scatter plot because there are like 2,000 companies in the scatter plot. And I'll give you the good news first and the bad news later. The good news is there is a positive relationship between PE and growth. We fit a line. The bad news is it's not the strongest relationship on the face of the earth. There's a lot of noise in this relationship. You say, why do you do this? I want to get a preview of what my regression is going to look like. When I run my regression now, what kind of R squared do you think if the strongest variable explaining P's looks like this, what kind of R squared do you think I'm going to get when I run my regression? Probably pretty low. So I didn't have my hopes up. I was actually pleasantly surprised this year when I ran this regression for US stocks. I got an R squared of 49%. That is about as high as a PE ratio regression R squared has been over the last 20 years. Take a look at the variables that I have in my regression. I have growth, beta, and payout ratio. Where do you think those variables came from? Remember last session we did the analytics of PE ratios. We broke it down and said, what is it that drives PE ratios? And the three variables we came up with, cost of equity, growth rate, and payout ratio. This is not a kitchen sink regression. This is a regression where I've restrained myself by saying, let's see what we can explain with the fundamentals. Okay. Throw the regression in. Let's go through the coefficients. First, there's an intercept. And the intercept is negative. It's going to be a bit of a problem in making predictions, but it is what it is. Basically, my regression line crosses below the x-axis, minus 12. Every 1% increase in my growth rate increases my PE by about 0.014. So higher growth rates, higher PE ratios. Along the way, I'm keeping track of my T statistics, right? So remember, 2 is the cutoff. This is way beyond 2, so growth clearly matters, and I can tell you higher growth companies have higher PE ratios. Saying this is good. We're getting the intuition kicking in. Then I looked at beta. Higher beta companies have higher PE ratios. Does it make sense? What do we say about the relationship between risk and PE? As cost of equity goes up, PE ratio should actually come down, right? Here I am increasing beta, and my PE ratio goes up. Don't do something stupid. Right? Run the regression, say that sign should be positive. Let me just draw a line through the minus. You can't do that. The data is what it is. And in this case, the relationship is positive. There's actually a simple explanation, a statistical explanation that cuts to the heart of these kinds of regressions I'm going to come back to. It is what it is. And higher payout ratio stocks have higher PE ratios. So I have a regression equation for the entire market. I'm first going to deal with that negative intercept because that negative intercept bothers me, and here's why. What am I going to use this regression for? To make predicted PEs for companies. When I have an intercept of minus 12.7, you know the danger I face? Is if I plug in numbers for a company, I could get a negative predicted PE, and I can't have that. And there's actually a very simple fix, though it comes with a cost, to a regression when your intercept is negative. If you use any regression package or even in Excel, there's an option where you can make the constant 0. In other words, you can take the intercept out of the regression. What you're doing is you're actually forcing the regression line through. So it's actually it's not as good a fit for the line, but you're basically forcing the regression through it. And when you do that, you're going to see the negative intercept disappear. But let's lay out what this regression's weaknesses are. First is those coefficients on the variables are unstable. How unstable? I've told you, I've been running this regression for 30 years. You can check the coefficients. They go up and down because the market changes its mind on how much growth is worth and how much risk is worth and what to put on payout ratios. The second is something I forgot from my statistics class that I was reminded of after I ran the regression. When you run a multiple regression and you have 3 independent variables, do you remember in your statistics class what your requirement was for they should be uncorrelated with each other, right? Or I think my statistics professor used the word orthogonal. I had no idea what he talked about, but basically it was uncorrelated with each other. Is there any chance that beta, payout, and growth will be uncorrelated with each other? What tends to be true about high beta companies? They tend to be high growth and low payout, right? These 3 variables are almost locked at the hip. So you're saying, so what if they're correlated? What does your computer see when you put in these 4 columns? You might call them beta, growth. It doesn't know. It just looks at columns. It makes its own judgment. So you know what's happening right now? Because high beta stocks tend to have high growth rates, the computer is getting really confused about whether beta is measuring risk or whether beta is measuring growth. And in this regression, beta is becoming a better proxy for growth than a proxy for risk. If this were a statistics class, we could spend 3 sessions on how to fix this. But here's the good news. This is called multicollinearity when it happens. You can still use your regression overall, just don't look too closely at the coefficients because the coefficients often will not make sense. Collectively, the regression is usable. But that multicollinearity will mean that your signs, so when you run a regression across your sector, don't expect all the signs to be exactly the way you thought they would be, because you're going to have multicollinearity in whatever sector you're looking at. Now let's talk about the intercepts. So basically I reran the regression. I took the constant out. The regression then has no constant, basically the other three variables that pop up. Beta has now become actually statistically close to insignificant. So I could have rerun the regression with just growth and paired. You see, can't take out beta? I can take out whatever I want. If it doesn't work, why leave it in? This regression is what I can use to get predicted PE ratios for US companies at the start of 2019. Yeah? Yes?
You need to change the coefficient, right? Because this is because the data shifted to the right in the axis, right? So it's cutting like this.
Right.
So probably anything to the right of it will only what will work, like growth, expected EPS, etc. Only to the right of it will work. So what you can do is anything to the left of it is probably.
You can't selectively remove data, right? I mean, so when you say left of it, what do you mean?
Forecast.
Right.
Anything to the left of it probably is a negative earning company or a company not doing.
No, it could be a low, very low. So basically you can end up with the problem with PEs is because once you go below zero, it's like going to a very high PE. It's not set up right. If you did earnings to price ratios, you could do what you suggested. Price earnings ratios, the problem is a negative PE becomes not meaningful. So you need something that flips it around. You can flip the PE ratio and that will work, but you can't do it with the PE ratio. Right? So let's look at the multicollinearity. Here's how you do it. Basically, you have any statistics package, you can do a correlation matrix. Here's what you'd love to see if you're running a multiple regression. See the beta growth and payout? You want these numbers in this part of the matrix to be all zero except for the diagonal. The diagonal, of course, is always going to be 1. You want those numbers to be 0. So that's what you're checking. Are these numbers 0? None of them obviously 0. You're saying, what are those stars next to those numbers? That's basically a measure of not only are they different from 0, but they're statistically significantly different from 0. We have a multicollinearity problem. As I said, if this were a statistics, there are ways you can try to fix it, but I'm not even going to try. It's just going to be too messy. I'm going to stay with the regression, knowing that the coefficients are going to give me signs that I really am not that comfortable with. So let's see how you'd use this regression. Let's suppose I came to you with numbers for Disney, and I told you Disney's growth rate is 15%, beta is 1.25, and its dividend payout ratio is 20%. So I just pull them right off Capital IQ. I have a regression, right? I can go plug in my numbers into that regression. I get a predicted PE of 26.8. Let's say the stock is actually trading at 25 times earnings. If I were going to describe what I've just found, how would I describe it? What would I say about Disney? It's underpriced. So first I want to take the value valued out. It's underpriced given how the market is pricing all other companies in the US. See why I want to be careful about that recommendation? Because if I ran a regression of Disney against just entertainment companies, is it possible that I could find Disney to be overpriced against entertainment companies and underpriced against the markets? Absolutely. Pricing is always a relative judgment, who you compare it to. Think of this as just adding another dimension to your pricing. It's not an either or. So when you price your company, you might price it against your sector, and then you might price it against the entire market. You'd like both of them to give you the same answer, but if they give you different answers, again, you have to pick which pricing you think is the better pricing to focus on. So one thing I've kept track of is that coefficient on the growth rate, because I said that's what you get as in terms of PE ratios. So think of that as the price that the market is willing to pay for higher growth. So as you can look across time, the number's gone up and down. So when the number is high, the market is paying a lot for growth. So when you're a high growth company, you get a much higher PE ratio. In the last column, I've also computed the implied equity risk premium, saying what's that got to do with anything? The implied equity risk premium is the price for risk. So you've got a price for growth and a price for risk, right? Let's go back to the start of this graph. That's a peak of the dot-com boom. How much is the market paying for growth? A PE of 2.1 for every 1% increase in the growth rate. So the market's paying a lot for growth. And look at how little it's charging for risk. Almost nothing. So if you're a high growth, high risk company, this is nirvana. The market pays you huge amounts of growth and doesn't punish you for being risky. You're going to get stocks trading at 80, 100, 150 times earnings. Track that company through time, assuming nothing about the company changes. It stays high growth and high risk. 2 years later, after the dot-com boom is completely busted, look at what the market's paying for growth. It's down to 1.003. So you're getting half of what you did for growth, and the equity risk premium is almost twice what it was 2 years ago. Same company 2 years later, its PE ratio, which used to be 100, will be down to 40. And the CEO is going to say, what the heck happened? You are being priced by the market, and that pricing can change over time. In buoyant times, the price paid for growth goes up, the price paid for risk goes down. In crises, the reverse happens. If you look at 2008 and 2009, you can actually see the consequence, see the drop-off in how much the market's paying for growth and how much the price increases. And you can see how markets, the multiples you're going to see, are going to shift over time. So I tried this with PEG ratios. And I'm going to do the PEG ratios for a simple reason, because it's like a very quick review of statistics. Before you run a regression, you're always asked to run a scatter plot. And we all do this because we're asked to do it. There's a reason, though, for running a scatter plot. You know why you should run a scatter plot? Because it tells you, because the regressions I've been running so far are linear regressions, where I take PE against growth, price to book against return equity. The problem, though, is if the relationship is not linear and I try to fit a straight line through it, I'm going to get some strange results. So one reason you run the regression is, is it okay for me to run a linear regression? So with PEG ratios, I took the PEG ratio, and because remember the growth was always that unstable variable, and I regressed. And I put a scatter plot. What do you see? At least I might be seeing it like cloud reading. You see whatever you want to see. I actually see a line that runs like this. So what do I do now? I know my statistics professors are going to be horrified by what I say. I've discovered when you have something like this, if you take the log of the variable, that is your independent variable, magically things become more linear. There are lots of different you can square it, you can take the square root, you can take the exponential. But for me, the natural log, so if you're thinking about in a calculator, you're running what are all those different logs? This is the natural log, not the log base 10. You have no idea what I'm talking about. Just go back and look at your calculator. It's a small ln, not the big log kind of thing. So hit the right log. And what it'll do is essentially what it does, it actually takes numbers that are very divergent and makes them closer to each other. So I run that. I took the log of the growth rate, and magically I'm starting to get, it's still a horrifically scattered plot, but the line's starting to get more linear. When I ran my regression with PEG ratios, I threw in beta, payout, and growth. My R squared was much worse. But again, remember, this was not my weapon of choice. I didn't want to use PEG ratios. All this tells you is PEG ratios are really tough to explain. And here at least the intercept was positive. I didn't have to do the constant being 0. But if you gave me this regression, I can get a predicted PEG ratio of companies. In fact, if you had a powerful enough regression, you could price every company in the market in 5 minutes, basically. Just plug it in. But then you got to hope your regression actually acts as a convergence mechanism and things revert back to it. So there's my PEG ratio regression. And you can see higher growth, at least across all companies, translates into a lower PEG ratio. One thing about that regression, though, if you look at the log of the growth rate, the T statistic is not, that's definitely not significant. So if you were running this regression, why leave a noise variable still in there? So I reran the regression and took out the log of the growth rate. What I'm trying to say is if you run a regression and there are 4 variables, don't get stuck on it should be significant. If it's not significant, take it out of the process, because otherwise all you're doing is adding noise to your predictions. So this is actually the PEG ratio regression I'd use to get predicted PEG ratios for individual companies. So it's my first week of every year, this is all I do. And it's actually kind of fun because you get to look at the data rather than hear some expert tell you something about this is what should be. And it's always, you'll always get surprises where you find in the data things that go against your priors. So I start with PE ratios, I do what I did with the US, then I do Japan, and I do Europe, and I do global, and I do with PEG ratios and price to book and EV to EBITDA and EV. And even though I'm not a pricer, I need to be able to understand differences in pricing. And when I'm done, I actually summarize all my regressions in a series of pages. It's on my website, I've kind of put it in here. Yeah. I've summarized what I found with regressions by region, and I run a global regression. 43,000 companies. I'm getting law of large numbers working in incredible power for me. With every single region, I start with PE against beta, growth, and payout. But if in a region growth doesn't get significant, I take it out. So I have no qualms about removing a variable if it's just adding noise. I have PE ratios. You think, how am I going to use this? You come to me with any stock in any part of the world and you ask me to price it, I'll just plug it. So if you come to me with a Japanese stock, I'm not going to plug it into the US regression, I'm going to plug it into the Japanese regression. The R-squareds are actually fairly healthy for big market regressions for PE ratios, but they vary across the regions. Why? Because some regions, it's easier to explain difference in PE ratios than in others. There's my price to book ratio regression. With each one though, what I want you to focus on is the variable that pops up that you did not see in the previous regression. Price to book, see the variable that pops up? It's return on equity. Return on equity is by far the most statistically significant variable explaining price to books in every part of the world. Remember I called it the companion variable? One of the ways you can come up with companion variables is as you run these regressions, it'll consistently be the one with a t-statistic of 45, 50, 60. Huge, simply because it's such a dominant variable. In fact, if I'm in a hurry, I'll just run price to book against return equity. The rest adds relatively little to the regression. But basically, I've got a regression for every part of the world. EV to EBITDA, again, and you'll notice that the variables are the same across every part of the world. It is not the variables that change. It's the same fundamental multiple and determinants. When I ran my global regression, there was one additional variable I thought about adding that might actually make the global regression more powerful. What am I not controlling for when I do debt ratios, growth, and tax rate? Global regression includes stocks in Brazil, stocks in the US, stocks in Europe, stocks in Russia, right? I actually considered throwing in my country risk premium in there because I have it for every country. And it does improve the regression. I just left it out because then we run into how you, especially in pricing then, I'm asking people, because I want this tool to be available to people who don't like to do intrinsic valuation. If you don't like to do intrinsic valuation, you probably don't like this country risk premium stuff. You think about it as a waste of time. But you could actually think about the things you worry about in ECF and start adding them into your pricing and build up a regression. Incidentally, those of you pricing your company against companies which are global, you can do this. Add a country risk variable in there and see if it matters. Maybe it won't. Maybe the market doesn't care. And finally, I looked at EV, actually, I have EV to invested capital, EV to sales, and notice the variable that pops up now is operating margin. Companion variable pops up. There are my R-squareds. Not great. I have a really tough time explaining differences in revenue multiples across countries. But again, I have the basis at least for making a prediction. Finally, EV to invested capital. Key variable, return on invested capital. If any of you have money-losing small companies and you try plugging them into these market regressions, you're going to get either very low multiples or negative multiples. You see why? Because right now your return on invested capital will be negative, your margins are going to be negative. So if you want to run these market regressions on a young company, what's your only choice? You've got to project out and use the forward numbers, which is part of the reason it's always good to do your DCF before you do a pricing, because you have those numbers in year 10, right? At least I compute an imputed return on capital, but you could do the same thing and use that in the regression. You will now get a predicted EV to invested capital in year 10. And you have to do the rest of the cleaning up. But it's kind of a more slightly better way of thinking about future multiples than just taking today's average and just plugging into year 10. Along the way, though, don't operate under any illusions. One of the illusions that people with pricing have is, hey, it's not subjective, it's just a multiple. But think about the choices you had to make. First, in the numerator, you got to pick market cap, firm value, or enterprise value. You also decided what your scaling variable is. Is it revenues? Is it cash flow? Is it earnings? Is it book value? You get to pick. And on each of these variables, you get to decide whether you want to use last year's numbers, trailing numbers, forward numbers, or really forward numbers. And finally, when you talked about comparables, you decided what was in your peer group. Nothing wrong with any of these things, but I'm saying that if you're arguing that this is somehow objective, my point is everything is subjective. You make the choices. If you have strong biases, I know exactly where your choices will lead you. So if you're optimistic about Uber, you're going to be doing everything off gross billings because you get $128 billion as your projected equity value. If you're pessimistic, you're going to do it off, I don't know, riders or cities served because you get a much lower number. So it's what you choose will reflect your biases, and might as well be open about those biases. So let me list out what we've kind of encountered along the way in pricing, and you can tell me whether you disagree. In pricing, when you tell me something is underpriced, you got to finish the sentence, right? You got to tell me underpriced relative to what? Relative to the sector, relative to the market, because underpricing is always a relative statement. So you just leave it at underpriced. I have no idea what you even mean. And when you do find something to be underpriced, remember, all you found was the cheapest stock in this group. So if I tell you, after all 5 ride-sharing companies are listed, that DD looks underpriced, you got to be very careful, because it could be underpriced against Uber, Lyft, Grab, and Ola, but it could actually be massively overvalued still because they're all overvalued. So when you go the pricing game, one of the risks you run is you're making a statement that's always a relative statement. Second, if you're doing equity pricing, give up on the notion of finding a company exactly like yours. It's not there. There are so many dimensions in which companies are going to be different that even at their peak, when people used GM and Ford as comparable companies and compared this, they were very different companies. In fact, this was the hubris that led to something called paired trading in the 1990s. Heard of long-term capital management? If you get a chance, read that book. It's a testimonial to hubris and where it leads you. Because long-term capital management was this company founded by John Meriwether, who was Solomon's bond trading star. He decided to start long-term capital management, hired the brightest minds on Wall Street, and then added 2 Nobel Prize winners to the mix. So what he brought was pedigree. Look, we know what we're doing. We've done this successfully. And they were initially very successful because they focused on fixed income arbitrage. But they were so successful, money started to flow in. That's a problem. You know why it's a problem, right? More money flows in. You now can no longer do what you did before because that market is not big enough. So they decided to do equity arbitrage, which is an oxymoron. You see why fixed income? Why is there arbitrage? Because there's a finite maturity date by which everything's got to kind of get fixed. Equity, what's your maturity date? There's none. And one of the strategies they adopted was paired trading. So what this would be is they'd take 2 stocks that historically had high correlations with each other, and then they would come up with some pricing range. So they say, stock A should always trade at 1.5 times stock B, and historically, because of the correlation, whenever that ratio gets violated, we're going to buy the cheaper stock and sell the more expensive stock. So they created paired trading strategies, essentially in equity. And in 1997, when Russia blew up, it destroyed long-term capital, but the part of long-term capital management that really blew up was the paired trading. In fact, John Meriwether, in the letter he sent out liquidating long-term capital management, essentially blamed paired trading for the mistake, as if paired trading, was thrust upon them. But this is, I think, the reason you have to be careful about not making this a search for, let me find the perfect company out there in terms. That's why you need tools to control for differences, because no matter how careful you are, you have to. And finally, while I've used the word relative valuation, I think I need to stop using the word valuation. I think we need to call it what it is. This is pricing. So when I sound like I'm nitpicking on people saying the word value, it's because I think if we call it what it is, pricing, this process becomes a much cleaner, more honest process. We can actually have a discussion about what the right pricing for Uber is without letting all this distraction about value come into the mix. So let me list out the 4 steps to using pricing right. Define, describe, analyze, apply. Define, make sure your multiple is consistently defined, uniformly estimated. Describe, put up that histogram, get a sense of what's high, what's low, the 10th percentile, the 90th percentile. Analyze, look at what drives that multiple by going back to a discounted cash flow model, and only then apply the multiple. So now we've finished the heart of this class, valuation and pricing. I'm going to take a few detours. Here's the first one. Often when you tell people there are only 2 ways you can put a number on a company, you can value it or price it, they say, no. What about asset-based valuation? You know what asset-based valuation is? In asset-based valuation, you value a company by valuing the pieces of the company. Okay? You're saying, why would I want to do that? Remember though, when you do asset-based valuation, to attach a number to a company, you've got to use an approach. You can either do intrinsic valuation or you can do pricing. So asset-based valuation is not a different way of doing valuation. It's an application of either intrinsic valuation or pricing. So let's look at the scenarios where you might have to value a company from the ground up. First, you might be called in to attach a liquidation value for a company. Do you see why you might want to value the assets there? Because in liquidation, you're not selling the company, you're selling it in pieces. So in liquidation valuation, you have to attach a number to each piece. Would you use intrinsic valuation or pricing to attach a number to each piece if you're doing liquidation? It really should be called liquidation pricing, right? Because you got to get rid of it. So if GE called in and said, we're going to have a fire sale and shut down, you're really doing a liquidation pricing. The second scenario where you might have to put numbers on pieces is fair value accounting. The mission in fair value accounting is you now want to come up with updated numbers for items on your balance sheet. It's a nightmare, but we asked for it when we said we're going to do fair value accounting. So there you might have to come up with a number for each one. We look at what the mission in fair value accounting is and whether it should really even be called fair value accounting. The third place where you might do valuation in pieces is if you're an investor planning to take over a company, a multi-business company that you think is worth more broken up than as a standalone company. It's called sum of the parts valuation, though much of what passes for sum of the parts valuation is really sum of the parts pricing. Again, I'll come back and back up that statement, but essentially those are the 3 scenarios where you're interested in asset-based valuation. Okay? So your job is to do asset-based valuation. Let's think about how we could get that asset-based value. Again, as I said, you can do an intrinsic value of each piece. You can do a pricing of each piece. Or you might even trust the accountants to take the book value of each piece. There are some companies where valuing the pieces is easier than others. Okay? And I'll give you the conditions that will make your life easier if you have to do a sum of the parts valuation or pricing. First, your assets have to be separable. If they're entangled, it's much more difficult to do a sum of the parts, pricing or valuation. If you gave me a real estate company with 7 real estate holdings, it's relatively easy to do a sum of the parts valuation or pricing because I take each piece and I put a number on it. But if you gave me Disney to value and say, can you value the theme parks? That's going to be difficult. Do you see why? Because the movies, the theme parks, the broadcasting all kind of are entangled. In fact, I'm going to show you my pricing and valuation of GE. And you know what the most difficult part of GE to separate out is? What's the most disastrous part of GE actually? If GE could get rid of it, what part of GE do you think GE would get rid of? GE Capital is a nightmare for GE right now. I'm going to show you my valuation of GE Capital. It's actually reducing the value of GE by about 20 billion. The only problem is GE Capital is not easy to get rid of. Why? Because GE Aircraft, all those contracts, GE Capital is funding them, and it's not easy to disentangle it. This is the problem with trying to sell off a financing arm of a company. GMAC had the same trouble. Ford Capital had the same trouble. Volkswagen, who tried to sell off its capital, would have the same trouble. So you need separable assets. To the extent that they have standalone earnings, your life gets simpler. Whereas if their earnings are all intermingled, much more difficult. And finally, it'd be nice if there was an active market for just similar assets, because you can get, if you're doing DCF, the inputs you need for DCF. If you're doing pricing, you can look up multiples. So let's take each of the three scenarios. We might do asset-based valuation and look at what your task is and why the way you approach it might be different. In liquidation valuation, the first thing to remember is you don't have the luxury of 5, 10, 15 years. You got to get your money back quickly. And because you're selling off pieces, it actually makes more sense to do a pricing than an intrinsic valuation because it's what people will pay. But there's one added concern, which is if you're trying to sell something in a hurry, you can do a pricing of that asset, but odds are you will not get that price. Why? Because people sense desperation. They say, okay, you think it's worth $1 billion, I'll offer you $500 million. And to the extent that you don't have lots of potential buyers, the liquidation pricing for assets has to reflect that fact that you might not be able to get even a fair price for it. When I did Las Vegas Sands, this was my concern, is if you try to liquidate 11 huge casinos around the world, it's not like the list of potential buyers is a mile long. You might have 2 potential buyers and they're both in trouble when you're in trouble. So liquidation valuation is simple until you come into this question of how much will I have to leave on the table. And there's fair value, accounting valuation. When the fair value accounting rules were being written, and this was about 15, 20 years ago, the panel met in New York. And somebody on the panel called me and said, would you be willing to come in and talk to our panel about our mission of doing fair value accounting? And I remember asking, are you sure you're talking to the right guy? You know what I say about accountants all the time. And they said, we've heard. But that's okay, come and talk to us. We're willing to overlook your past insults. I said, okay. So I said, can you send me the basic rule that you're going to send out to drive? So they sent me this thing called FAS 157. And that's the thing about accountants. The rules run into the hundreds and thousands. So I take a look at FAS 157. Now I'll cut to the chase. Here's what I saw in FAS 157. They said, FAS 157 said it would like accountants to attach a number to assets and liabilities that reflects what you would receive from market participants today. I read that mission and I said, is that a pricing mission or a value mission, you think? That sounds like a pricing mission. So the first thing I emailed them is, why do you call it fair value accounting? Why isn't it called fair price accounting? They said, what are you talking about? I said, there are 2 different words here. Your mission is a fair price. And they said, is that wrong? I said, no, you can do fair price accounting. And I went in and said, this is fair price accounting. Don't do DCFs and do gymnastics. Fair price accounting, you got to come up with the right pricing for an asset. And they wrote the rules, and unfortunately in the process of writing the rules, they then said, when accountants put this number on companies, they have to turn in a DCF to back it up. You put out a fair pricing mission, and you ask people to do DCFs. You know what you're asking them to do? Get into yoga poses from which they can never get out. Okay? It's a contortion. I remember when there was when you're a private equity investor or even a public investor in private, you're required to revalue, accountants say, all your holdings every 6 months. So a couple of years ago, I get a call from the accounting team at Fidelity. This person on the team had gone through this class, I think. He called and said, we're at Fidelity, we're trying to revalue their Uber holdings. And I said, what's the problem? He said, we kind of know what the number is because it was right after a VC transaction had happened at about $50 billion. They own 1% of Uber. 1% of $50 billion is $500 million, right? They said, we kind of know what that number is. We're trying to get a DCF model to deliver the number. We can't get close. What are we missing? I said, what you're missing is you're using the wrong tool for the wrong end game. You have to price something, you use a DCF. If this company is being priced way above its value, that DCF model cannot deliver $500 million unless you break pretty much every rule in the book. And I said, go ahead and break every rule in the book. Because this is not your fault. This is the accounting mission being written wrong. If you want me to do fair price accounting, stop asking me for DCFs. If you want me to do fair value accounting, go back and reword this so it is in fact fair value accounting. And this is again why we have to stop using the words value and price as if they're interchangeable. So next time somebody talks about fair value accounting, before they get too carried away, say, are you sure it's fair value or is it fair price? They'll have no idea what you're pushing against. But I think understanding the difference reflects some of the frustrations accountants end up with when they're put into this point of, hey, how do I use a DCF model to justify a pricing? Which brings us to the third and potentially most useful place for some of the parts, or for asset-based valuation, which is some of the parts valuation. Usually you will see this in the context of an activist investor challenging a company, like Sony. So you're worth more broken up. Okay. So let's think about how you would do some of the parts assessments of companies. So I'm going to pick a company that I used to call the poor man's GE, but now I call it the rich man's GE because it's actually become better than GE. It's United Technologies. It's a conglomerate. It's in 6 very different businesses. You can see them broken down. And the reason I picked United Technologies is they provide a breakdown of numbers by business that most companies don't. They give revenues, of course, but also EBITDA, EBIT, CapEx, things that you don't find most companies breaking down. So I have 6 different businesses, financials in each of the 6 businesses. What's my mission? To either price these businesses or value. Let's start easy. Let's price these. What's the simplest way I could? If you had only 5 minutes, or you've had a long dinner, you've had 3 glasses of wine, and somebody says, how would you price United Technologies? You pull up an envelope and say, let me show you how much I know about pricing. You have only 5 minutes to do it. What's the easiest way to do it? I just took the EBITDA. You're saying, how would I check the multiples? You're online, your phone, just get on my website, you pull up the EV to EBITDA. So there's the average EV to EBITDA, multiply the EBITDA by the EV to EBITDA. You got the estimated enterprise value. You add them up, you got a sum. You're saying, this is so unsophisticated. I'm drunk and I have 5 minutes and I can come up with this. Much of what passes for some of the parts valuation, you dig a little deeper, this is where you stop. You just apply a multiple to each part. You've done a pricing, but it's really a pretty crappy pricing. Do you see why? You're applying the average to each company. If you could do pricing right, first, you wouldn't use EV to EBITDA for every sector, right? Some multiples work better than EV to EBITDA. So here's what I did. Let me do a pricing that is actually based in the data. So what I did was I looked at the numbers and I tried different multiples in each sector, and I picked the multiple where I could get the highest R squared, the best explanatory power. So I ran regressions, trying to control for differences, and I ended up with 2 sectors where I used EV to EBITDA, 2 where I used EV to sales, and 2 where I used EV to capital because they work best. And in each one, I controlled for differences across the sector. Then I went in and plugged in the numbers for each of the sectors. I got predicted EV to sales ratios for each sector using the regression. Its pricing just carried one step further using all the data. With those numbers put in, the pricing that I get, where is the price? The pricing that I get for United Technologies is about 74 billion. Do you remember what it was with the simple pricing? It was 62 billion. But once I control for the fact that they have higher margins in some businesses, better returns on capital, the pricing I got was 74 billion. Incidentally, in both these pricings, there's a loose end I did not tie up. You know what that loose end was? Let me go back and show you the numbers. So this was a breakdown for United Technologies. And almost as a throwaway, in the paragraph that followed the breakdown, they said, by the way, not included in any of these companies is a G&A expense of 408 million. And every company will have this, like corporate expenses that don't relate to any division. When I did my pricing, I completely ignored that 408 million, right? Do you see what this is going to do? It's almost going to create a conglomerate discount even if it doesn't exist. Why? Because I've missed a 400 million. That's an annual expense. Think of the present value of that. When I do my intrinsic valuation, I'm going to try to make sure I bring that in. But in much of pricing, that's something you might want to check, is the next time you see a sum of the parts pricing of a company, where did the corporate expenses go? Some analysts try to be careful. They try to allocate it across the divisions. But if you don't, you're missing a big chunk of expenses, and that's going to create about a 7% discount. And then you write a paper about how there's a conglomerate discount. From that day on, everybody applies a 7% conglomerate discount. I'm not saying there isn't a discount, but this is a rotten way to come to that conclusion. So now let's talk about a sum of the parts valuation. To do a sum of the parts valuation, what do I need? I need to pick a discounted cash flow. It's a lot of work, but basically they've given me the raw data to do the work. So first thing I did was I computed the cost of capital for each business. Why? I need a discount rate. So I did the beta. So because of the way we've structured cost of capital, I can now do cost of capital, not just for the company, but for each business, because I use the bottom-up beta. In this case, I actually gave them all the same debt ratio, because they're all pretty heavy infrastructure businesses. But if I wanted to, I could allocate the debt giver. But basically, I end up with the cost of capital for each business. Next, I looked at what the numbers yielded in terms of return on capital and reinvestment rate. Why do I need that? Because I need to get a growth rate. And you can see across the businesses that this is a wildly divergent company. If you look at UTC Fire and Security, their return on capital is only 6.03%, which incidentally is lower than their cost of capital. But if you look at Otis, the elevator company, 35.7% is much higher than the cost of capital. They have 5 businesses that are value creating and 1 value destroying company. Now that I can do them in pieces, I can actually separate the companies. So the return on capital and reinvestment rate are very different across the businesses. So I know my cost of capital, I know the return on capital, I know the reinvestment rate. If I multiply the return on capital by the reinvestment rate, I get a growth rate. And the growth rate is obviously very different across the companies as well, ranging from 13 to 14% for Pratt & Whitney and Sikorsky, down to 3% for Fire and Security. And then I picked a DCF model for each one. Why? Because I can be, remember I said don't estimate things you don't have to. If you have the Fire and Security business growing at 3%, this was the time when the risk-free rate was slightly higher than 3.15%, why would I go looking for trouble by building a growth period? I valued it as a mature company today. The other companies are put in a period of growth. For all of them, none of them is going to be really high growth. They're all pretty big parts already of existing businesses. I gave the remaining businesses 5 years of growth. You see, one of the advantages of some of the parts valuation is you can take each part of the business and treat it differently, give it different characteristics. What's the disadvantage? It's 6 times more work, right? You need more data and it's going to take more time. Because to do some of the parts valuation, you need to take each business and treat it differently. So I did my present value. So I'll cut to the chase. I did DCFs of each one. I came up with values of the operating assets for each of the businesses. You add them all up. The value that I get for all of the operating businesses here is about $80.25 billion. I'm almost done, right? What's the one loose end? That $408 million that I haven't dealt with. Yes? Well, the synergies are already, you're saying are they the synergies are already in the numbers somewhere, right? Synergies there will either have to show up as higher operating income one business.
Right, but we saw like the lower
that's the point I made about interconnections across the business. If there are interconnections, this process becomes a lot messier. Like if I tried to value Disney's sum of the parts, I'm probably going to overvalue the theme parks business because they benefit from the spillover from the movie business. I'm probably going to undervalue the movie business. There's no easy fix unless you're willing to go into the numbers and because the company will never break it out, right? They won't say, well, 20% of my theme park business came from Avengers, the Avengers movie should get that, right? But if you work within Disney, you could potentially do that, right? And you can't sell off pieces, and that's why it'll become less likely you'll even try to do a sum of the parts breakup of Disney because it's going to be so much more difficult to essentially get the full value for your pieces. But that's a good point, is when you have divisions that get entangled, you're going to get this is going to be much more difficult to do. The advantage of companies like United Technology, these are really 6 standalone businesses. Their Sikorsky has nothing to do with Otis because originally they were all standalone companies brought together in a conglomerate acquisition wave. It's not like, so that's why I picked United Technologies as an example. It's going to be much more difficult to do this even for Sony. Businesses are too entangled, right? So what's the loose end? $408 million. So what should I do with it? It's a DCF world that we live in. So what's the effect of having this expense on a continuing basis? It's the present value of expenses. They happen to be tax deductible, right? So what I did was I took the $408 million, assumed that they will grow, because this is a pretty large company for the most part. There's growth in the businesses, but I don't think the corporate has to grow at the same rate. Assumed it was a cash flow that will grow at 3%, which is my stable growth rate, applied the cost of capital for the whole company, because the whole company benefits from this, and I got a present value of 4.6 billion. What is that? That is, I'm going to call it the corporate drag. I like that word simply because it's what happens because you have corporate expenses. I subtract it out. I get a value for the operating assets, a sum of the parts valuation of 76 billion. Just to give you the contrast, what I got with my sum of the parts pricing, with the sophisticated adjusted pricing, was about 74 billion, but I didn't count the 408 million. So that's my value of operating assets when I did a company DCF, a top-down DCF, was about 71 billion. And if I did the pricing, the market price was 52 billion. The good news is all of the numbers were higher than the market price, but you can already see that if the market price falls in the middle, it becomes an interesting problem, because as a passive investor, obviously you can't buy UT and break it up. But to the extent that you see activist investors on the horizon, you might be able to do something about it. And just to close this particular section, I hate the colors, I'm sorry. This is kind of mind-bogglingly bad. But this is about last year, towards the end of last year, when GE was going through its problems. In fact, this was the second valuation of the week. I did a GE valuation by piece, and you can see each piece gets its own cost of capital. None of them are high growth businesses, so I could actually do this stable growth model for every one of them. And you can see the inputs vary across companies, very different costs of capital across companies, very different returns on capital, and I also computed the average over 5 years. I was trying to get a sense of, hey, which of these companies are value creators? If you look across the average numbers, the green businesses are their value-creating businesses. They're aviation, healthcare, and transportation. That ugly yellow businesses are businesses which are on the margin. They're either slightly above or below. This pink, or whatever that color is basically the businesses where I'd worry the most, because those are businesses which are either seeing negative growth or, like GE Capital, are just losing value. So I valued each piece, and this is my DCF valuation of each piece. And just as I did before, I basically took the GE corporate expenses, and in this case I think I actually allocated the corporate expenses by business, because they gave a rough breakdown of where the corporate expenses came from. So rather than have it as a separate item, if they hadn't done that, I'd have done exactly what I did with UT. So the value per share that I got was about $10.92. But by this time, you already had a new CEO, and he said his objective was to try to sell off businesses very quickly. And the minute he said that, I knew that an intrinsic valuation might not be the right tool then. I said, what would the pricing look like if I were trying to sell? And here's what I did, and this is it's that simplistic valuation. Why? Because by the time I got to this point in my post, I was just tired of GE. It was making me really depressed to even work with the company. I just want to get away. So I just applied a peer group EV to EBITDA, came up with a value of about $12 per share. Incidentally, when I did this, the stock was trading at just below $8 per share. Right? So both the valuation and the pricing was suggesting it was undervalued. Right? I mean, this is a company where this is going to be the way we think about the company. It's no longer a top-down company valuation. It's going to be, can the pieces be worth more than the company itself? I have about 7 minutes. And I'm going to say something about how this has changed because until 3 years ago, I used to do some of the parts on companies like GE, United Technologies. But 2 years ago, when I was valuing Uber, I did a top-down valuation of Uber then, and I came up with a value of $35 billion. I think I might have told you the story at the start of the class, but I got a pushback saying you're applying 20th century technology to a 21st century company. And what they were talking about was Uber's value derives not from the revenues you see or the margins you see, but from the fact that there are millions of riders. This is the paradigm, business paradigm now, right? It's subscribers and members and riders that drive value. And it's not just the new startups where this is true. Adobe shifted entirely to a subscription-based model, and it's done really well for them. Microsoft's crown jewel now is Office 365, which is a subscription model. So there is truth to the statement that companies are thinking in terms of users and subscribers and numbers. But he said, you're using a DCF model. And initially my response was, what the hell are you talking about? This 20th, 21st century always gets me going. But then I said, you have a point. But the problem is not with DCF, it's with me. You can value a rider, you can value a subscriber, you can value a member. So if you go look at the Uber rider-based valuation that I did on Sunday, I'm doing the analogy, equivalent of sum of the parts. What am I defining as each part? Each rider is a part. I'm valuing riders. So essentially, I'm bringing that approach to pieces of the company. I'm just defining those pieces differently. I'll send you a link to a paper that none of you will probably read. It's called Going to Pieces, about, I call this disaggregated valuation, where you value companies from the base up. And it's actually a different perspective. It shows you how flexible DCF is. Because we know what the value of a rider is. It's the expected cash flows from the rider discounted back at a risk-adjusted discount rate. There's no magic there. You still have to make estimates about how long. You know what the problem I have with these user, rider, subscriber-based companies is they like to talk the talk about users, riders, and subscribers. But to value a rider, what do I need to know? I need to know expected life of a rider. I need to know renewal rates. I read those 285 pages that Uber put out, hoping that somewhere along the way they would tell me what percentage of riders dropped out. Not one mention. Okay? Trying to get a sense of, can you give me the actual expenses on a rider level? Nothing. I had to make a guess of what's... If we're going to let companies get away with using users, subscribers, riders as their rationale for getting high prices, you know what we should require in return? Disclosure about those riders. You know what I'd love to know with Uber? What percentage of drivers drop out every year? That's a huge factor in what the value of Uber is going to be. Because if you have a car, right now, they're primarily a car service company. You can call yourself a personal mobility company, a transportation service company, a logistics company. This is a car service company. And what's a car service company built on? Automobiles and drivers. You don't own the autos. Your drivers are free agents. And if they don't like you, how do you build a great business on that basis? You know how many emails I've got from Uber and Lyft drivers in the last 4 days? Thousands. I actually have to create a smart mailbox trying to figure out what an Uber or Lyft driver. Somewhere along the way, say, I'm an Uber or Lyft driver. So I'd put Uber driver, Lyft driver. I've got all my Uber and Lyft receipts now in there. But to a person, it's amazing how angry they are at the company. When you get into an Uber car, talk to the driver. Say, are you happy with Uber? Have the annual report. Say, they have the smiling driver face. Is that your face? Because we read the annual report, it's like this, we've created this glorious way for people to make a living. And if it's a glorious way to make a living, there are a lot of exceptions to that rule. So if I were pushing Uber, one of the questions I'd have is tell me whether it's 1%, 7%, 17%, or 37%, because that's going to, they actually have, if you get a chance, go read the prospectus. They have this very shady excess driver incentives line item. I don't even know what that means. Excess over what? But they basically added back saying that shouldn't have been subtracted because that was a one-time deal. My guess is that they pay drivers to stay on, and they're acting like it's a one-time deal, but it's a one-time deal only if those drivers are coming and staying with you for the rest of eternity. But it's going to be every year if you have drivers who don't like you that much. So if you get a chance, go through that rider model. In fact, go through the first one, the 2017 model, because there I describe it. And if it captures your fancy, read the Amazon Prime, because I value an Amazon Prime member, a Netflix subscriber, a Spotify subscriber. I always go crazy with these platforms once I have them and try them out. Before you leave, there is an announcement that...
Thanks, Professor. Hey, everybody. Just a brief announcement before you leave your class. I know some of you guys heard this in the last class before this. I'm sorry. My name is Jordan. I'm with Special Events. We coordinate a lot of the student activities each term. Some of you might be familiar with some of these announcements if you took classes here in undergrad. We look for fun, inexpensive things for us to do outside of class every single year. Something we had done before that was popular, we decided to do it again, is we got an allotment of student faculty passes to go see a 2-hour live comedy show at a place called the New York Comedy Club, which is located on 24th Street, and they just opened another one about 3 blocks away from here. It's a really famous place, one of the most famous comedy clubs in the world. When we did this last time, people did see Kevin Hart and Chris Rock perform there. Normally to go, it's expensive. They charge $50 to see a show. Through the school, they give us student passes to go for 90% off. Woohoo, you guys are excited, I know. Instead of $50, they're $10 and they admit 2 people, so it ends up being $5 per person. The passes are valid till the end of 2020, so you do have well over a year and a half to pick a night to use them. They have multiple shows 7 nights a week. There's no restrictions or any blackout dates on them. You just have to call ahead and make a reservation. When you get there still is a standard 2-item minimum. However, you don't have to be 21 to go. Most of you guys are. Drink whatever you want. Younger boyfriend, girlfriend, apple juice, chocolate milk, stuff like that. And lastly, you have to be part of the school to get them, but you can take friends or family. A lot of people do get them as gifts. It looks nice. It says $50 on it. We don't get a lot. We pass them out first come, first serve in the classes till we're finished. So if you would like to get the tickets, they're $10. They admit 2 people, and you have over a year and a half to go out and enjoy yourself whenever you want to go. So if you want to get the tickets or if you have questions, I know I said it fast, I'll be right on this side of the room. If you don't have cash, you can use a card or Zelle or anything else.
Hi, sorry, I think I sent you an email regarding to Uber, but I guess it's very in advance of you now. So it was, I tried to use like an assumption, like in the Excel spreadsheet, and I came up with a valuation of $80, and then I used the 2017 financial.
No, I got it this morning.
Oh, all right.
But remember, that doesn't prove anything, right?
Yeah.
All it says is Uber's pricing at the end of 2017 is consistent with what you're finding as the value. Uber's never valued the company. It's always priced the company. It's a VC pricing.
Okay.
Basically, the way they came up with the 4384 is they took the most recent VC pricing, which gave them a value of around 42 billion, and they used that. That was right after SoftBank funded them. So their pricing had dropped because SoftBank had pushed down the pricing. So if they'd done it 6 months earlier, they would have used the Saudi VC range. They would have given them a pricing of 60 billion. So the story you're telling is plausible, right? It's a story about going forward that it's that. The question you got to ask is the business you're describing then is going to be a very different business. Right? The question is Uber the company that is best positioned to take advantage of an autonomous car business where technology is going to be the driver? Let's face it, Google with Waymo has a tremendous advantage over either Uber or Lyft because it's got capital, it's got the technology, it's got the cars. Uber and Lyft will have to spend incredible amounts to try to catch up. So one of the things about these new auto businesses that are described is many of those businesses are going to be very difficult for Uber or Lyft to succeed in because they're going to be very different businesses. So the 88 billion is plausible, but it will require that Uber somehow make this transition from what it is today, which is a very good ride-sharing company, to a company which is actually building a very different set of competitive advantages.
Thank you.
And the second one you asked was about SoftBank,
Yeah,
right?
so it's
If you screw up, it's very when you screw up that much, it's very difficult to cover it up. So they'll have to just take their lumps. There's no way they can back out of a mistake that bad. Is usually that'll show up as a drop in the price. And SoftBank has made some mistakes like those, where they've had to write off 15, 20, 25. If you do it, just write it off and view it in your portfolio. As I hope that, I don't know how much money they lost when Tencent lost 80 billion, right? I'm sure that SoftBank probably lost 7, 8, 9 billion. So their nightmare is that Tencent, JD, Alibaba all kind of go down at the same time because then you're going to get a repricing effect because they then have to reprice everything on the way, which will create a ripple effect because then they have to show that as a loss and then their stockholders will react. So it's a whole set of bad stuff that's going to happen, but it's unavoidable, right? If you make a mistake that big, you can't hide it. Yeah.
wow. It's so sad for them.
Don't be. They've made a lot of money over time, so that sometimes you make mistakes. And Masahiro-san is a smart man, but he's too sure of himself, and I think that sometimes gets you into trouble. And you're that convinced that you know what's going